Good afternoon, and thank you for joining this week's live and virtual educational event from Legal Aid Service of Collier County. Today, we're going to be discussing taxes and your rights and responsibilities. My name is Kathy Guerra, and I'm the director and tax attorney here at Legal Aid of our Low Income Taxpayer Clinic. Today, the agenda, we're going to discuss CARES Act and some of the tax benefits and reliefs that it grants to taxpayers for their 2020 tax return. And it's crazy to think that we are just about 2 months away from tax season. And I think it's very important for you to understand, like I said, some of the benefits that the CARES Act provides. Then we're going to be discussing taxable income. As we know, the pandemic has impacted all of our lives, a lot of the clients that we serve, a lot of the people in our community. And it's important to know what kind of income that you've received or benefits or grants or loans are going to be taxable for the 2020 tax season. I also want to discuss some of the self-employed and small business tax issues that I see on a yearly basis. And once again, being the pandemic impacting our financial part of our finances, I see in a lot of my own clients and a lot of members of the community going from having a steady job to maybe being furloughed and now being part of this gig economy. So the importance of what a self-employed person, what are the taxes and responsibilities for that self-employed individual. Then I want to discuss the credits, the two basic credits for family credits, meaning the earned income credit I'm going to put into this pile, child tax credit and educational credits. This is the second item of audits that happen in the IRS. So I want to make sure that we provide some information. Then I want to talk a little bit about VITA and the resource that it provides to the Collier County community. And the last thing is the LITC, the Low Income Taxpayer Clinic, or my baby, and what we do and what are we, how do we qualify for services. So with no further ado, let's start. We talk about CARES Act, or the Corona Aid Relief Economic Security Act. And the first relief or benefit that it provided, and I think we've all talked about it, the $1,200 check, the rebate check, stimulus check, the economic impact payment, whatever you want to call it, but those $1,200 that were granted per individual through the CARES Act. By this time, most people have received their stimulus check. And if you received it, if you file single or married filing separate, you received $1,200 and your income was $75,000 or less during 2018 or 2019, depends on what the IRS, which tax return they used. If you file jointly, then you should have received $2,400 and $500 additional per child. However, we have some issues. I'm still working with some clients, working on individuals who haven't received it and they file their tax returns on time. And so dealing with some issues of identity theft. We're dealing with some people who failed to do the advanced premium tax credit reconciliation. So their 2019 or 2018 tax return hasn't been processed, and that's the reason they haven't received their stimulus check. We're dealing with domestic violence survivors, individuals who filed jointly for their 2019 tax return, and now there's been some type of domestic violence activity in the household, and now the aggressor does not want to provide the $1,200 to our clients. So we're working on those type of cases. Also, we're working with some of the individuals who filed the non-filer. The stimulus check was, anyone who filed the tax return was eligible if they meet the income category, or if you don't have to file a tax return, but you have Social Security benefits, you should have received it the same way that you received the Social Security benefits. Some of the issues that I'm seeing in that community is that the IRS did not, or the Social Security did not provide the IRS the correct direct deposit information, or for some reason that person had a filing responsibility that they didn't know. Could have been, like I said, most of them is because of that Obamacare or health insurance through the marketplace. So we're helping those individuals. Another batch of individuals that we're seeing is, for example, I'm married, I have a child, I filed jointly with my husband or my partner, and all of a sudden I only got $1,200 of stimulus check. What happened to the rest? You know, like I said, I had a child, so that's an additional 500 plus the $1,200 for my spouse. Those you are going to have to file a 2020 tax return, even if you're not required to do so because your income level. If you want to claim the additional stimulus check of the payment, you must file your 2020 tax return. Same way that they did open the stimulus check for those who don't have a filing responsibility, but you had to go ahead and file a non-filer request. That window closed on November 21st. That doesn't mean that if you didn't file by November 21st, now you're waiving your right. What you have to do is wait until the 2020 tax season and you file a tax return, and you can go ahead and claim your stimulus check. The IRS hasn't given us a picture of how the 1040 or the tax return is going to look like, but we are expecting for a line to be added to the regular Form 1040 to the tax return saying how much money you received on the stimulus check, and then the IRS will do their reconciliation if they owe you additional money. Okay. The other thing that the CARES Act provided, and I think is a very important one, is retirement funds. Retirement funds, you know, a distribution from a retirement fund before the age of retirement has a 10% penalty. Plus, of course, it becomes taxable income. So you have to report that income on your tax return. Then you have an additional to any tax responsibility you have from that, an additional 10%. The CARES Act came and said, look, you're not going to be responsible for the 10% penalty. We're not going to charge you that. And for 3 years, you can actually wait to report that income on your tax return. And if you, within those 3 years, let's say I took out $20,000, you go ahead and put the $20,000 back into a retirement account, then we're not going to tax you at all on that $20,000 because again, you put it back into a retirement account. This is important. This is not just, you know, I wanted to take out money for my retirement account to use it for whatever reason. You have to prove that you were impacted, whether you were diagnosed or someone close to you, family member with COVID-19, or your financial situation was drastically changed because of the pandemic. Your spouse or someone in your household lost their job, they were furloughed, whatever it may be, but you need to show that the distribution, and the reason for the distribution is because your finances were impacted by the pandemic. Okay, so those are the big things that I wanted to discuss regarding the CARES Act. Of course, the CARES Act provides more tax relief from, you know, the employer into the workforce. But I think these are the two most important that taxpayers are going to be working with during this upcoming tax season. So what is taxable income? We've seen a lot of families who's, you know, used to have steady income. They had, you know, they were W-2 employees, everything was good. And then the pandemic came and maybe they had to go into unemployment compensation. I need to let you know that unemployment compensation is fully taxable. I know that I've gotten a lot of calls from the community. I've seen a lot of my own clients who have received unemployment compensation benefits and they've asked not to have any taxes withheld. If your entire income for the year is less than the threshold of what the standard deduction provides, for a single person will be $12,800, for a joint return will be $24,800. So if you're more less than that, then not having withholding is not going to really impact your tax responsibility. But if you did make more than that, let's say you went back to work after having unemployment compensation, then maybe the withholding that you've had from your job is not going to be enough to pay for that unemployment compensation benefits received. So I just want to make sure that you do understand that any single money that you receive from unemployment compensation, it is going to be taxable and needs to be reported on your tax return. The state of Florida will send you a document that you will go ahead and use when you prepare your tax return. I put here Social Security benefits, and I don't want to confuse anyone. Social Security benefits usually are non-taxable. However, if you did make money from other sources, being you have a retirement account, you have a job, whatever it may be, then a portion can go ahead and be taxable. It just depends how much money you made during the year. Besides the Social Security benefits, the IRS can tax up to 80% of those benefits. One thing that I do wanna, and I will discuss a little bit further, is the business or self-employed income of 1099 miscellaneous. This seems to be one of those things that you need, if you know that you worked as an independent contractor, it may be the first year that you do this, whether it's an Uber, Lyft, Uber Eats, whatever, or this, the share drive or the driving, you need to wait for Uber to send you, or for that company to send you either a 1099 or what is called a K1. They tend to send them a little later than W-2s are being sent, but just hold on. You do have, in most of these gig economy companies, you do have an online account that if they don't send it to you via mail, you can download it from their platform. And I encourage you to make sure that you have all your documentation. You know how much, approximately where you work, how much money you earned, but wait for those documents to be received, because then you're going, if you don't report that in your tax return, then your tax return is going to be, the processing is going to be delayed. And if you do a refund, your refund is going to be delayed, and you may get hit with some penalties for underreporting your income. So again, it's very important to wait for all these documents to be received, or you can always contact your employer to make sure that you are going to be issued one of these forms. What is not taxable? Again, with the pandemic, we've seen a lot of people in our community, maybe you are a recipient of some type of grant, meaning that the county, they were giving grants for rental assistance, utilities and all that. Make sure that I want you to understand that any grant is not taxable. Any gift. So if you called, let's say, the United Way or Salvation Army, and they helped you with a month's rent, that is a gift that will not be taxable, okay? Also the same way that if you took on a loan, if you are, you're self-employed, or you have a small business and you took an SBA loan, or you took advantage of the CARES Act PPP loan program, that part of the loan may be forgiven if it was used for payroll purposes. Then this portion is not going to be, of course, taxable. And of course, the loans are never taxable because you have the obligation to repay. Also very important to understand that any child support that was received is non-taxable. Scholarships, I want to make sure that you understand that they're normally not taxable. But if you are a student, if one of your dependents is a student, make sure that the university or the school is going to be providing a 1098 T as in Tom. That's going to give you the amount of scholarship and the tuition that was paid. If the tuition that was paid is less than the scholarship, example, you paid in tuition $5,000, but it's reported that you receive a scholarship of $7,000, the additional $2,000 are that you have to report as taxable income. So just be aware of that. Moving forward, now we want to talk a little bit about the self-employed independent contractors. And like I said, I think this is a very important topic. The number one reason that people get audited is unfortunately because of Schedule C. Schedule C being for those taxpayers who are self-employed, independent contractors, have their own business, and they're claiming not only income, but also a lot of business expenses, mileage, and all that stuff. And a lot of employers also are tending to move from the W-2, someone who is a true employee, someone who gets taxes, deducted or withheld with every paycheck, to this independent contractor. A lot of taxpayers love this idea because they have the flexibility to be able to work whenever they want. If they want to take a gig, they do. If they don't want to take it, they don't. So the flexibility, but once again, we want to talk a little bit about the self-employed portion of our community. Like I was telling you, the gig economy, it says the Bureau of Labor Statistics says that about 1% of all taxpayers are somehow involved as in the part of this gig economy. This actually study was done, and is the latest study that they've provided. It was in 2016, meaning that the data, I'm sorry, 2017, meaning that the data comes from 2014, 15, and 16. I think the numbers is actually much bigger now. The gig economy having, like I said, I know a lot of individuals, a lot of my clients moved from having W-2 jobs to maybe driving for Uber Eats or something like that. So I think as this 1% is not realistic with the type of economy that we're having, and it's going to continue to grow. A good example is what happened in California with the Proposition 22. I know on November 3rd, we were all tuning to the news, watching the presidential, election, Congress, Congress being maybe shifted, but also this California Proposition 22. A lot of us in the tax community were looking into it because California had passed a law saying that some of these member of these workers in the gig economy should be treated as workers and not as employees, not as independent contractors, and should have the benefits of being an employee, health insurance, workers' compensation insurance if they get injured on the job, sick time, health insurance, like I said. So all these benefits. And the voters of California actually voted and said no, at least when it comes to the app-based drivers, Lyft, Postmark, all these, the Proposition 22 voters say they're going to be continued to be deemed and seen as independent contractors. A big win for this industry, in this case, I guess for a lot of the independent contractors who wanted once again to be treated as independent contractors rather than employees. This is just the one trend, and it's an example from California, but this is what's happening nationwide. And it is something that we need to be more aware of. Also, this is just a very interesting statistics from the US Census Bureau. This is more recent. In 2018, it actually was issued this year, 2020. They looked at the data from 2018 and they saw that 77% of all entities do not pay employment taxes, meaning that they're self-employed, they either contract the work out or they're sole proprietorship that don't pay any employment taxes. So there's more of the self-employed individuals operating these businesses. That's a huge chunk, 77%. So once again, understanding what you need to do and how to, what documentation needs to be gathered, how to keep the documents is going to help you a lot with the tax return preparation. And once again, like I told you, unfortunately, a lot of the individuals who file that Schedule C who are self-employed tend to be audited more and more by the IRS. But the first thing that we want to discuss, let's say you are issued a 1099 miscellaneous, or you are hired and you said they tell you you are going to be treated as an independent contractor. We're not going to be withholding any taxes, where you're not going to have any benefits. If you the first question that I have a lot of my clients, and I've seen this more and more happening in the last couple of years, is whether you should really be a self-employed individual, independent contractor, or is that person should be treating you as an employee, a W-2. So that worker classification, and the IRS, and I put a big piece of our law, of our tax law there, but I highlighted and I bolded the most important thing is the right to control. Whether the person who hired you has the right to control almost like everything that you do and how you perform the job. Do you have flexibility? Whether, let's say, a true self-employed person, I take the job home, and yes, I may have a deadline, but I can work in the morning, I can work at night. I don't have to portray it as being an employee. So once again, it's the right to control. And what the IRS is going to look at is these three factors, and this is a test, the behavior. So it's whether the company has the right to control what the worker does and how they do their job. The other one is the financial control and the relationship control. I don't want to go into a lot of detail because we have a lot of material to cover. I will give you my information at the end of this discussion, and you can always call me. And if you have any questions regarding this. I do have to tell you that the IRS and tax court, which is what a lot of these cases end up going to, because the IRS sometimes agrees with the taxpayer, sometimes they don't agree with the taxpayer, so sometimes they needs to be litigated, is they look at the fact and circumstances. It's not just one factor. Oh, the person tells me that I have to wear a blue shirt every time I go to and do whatever I'm being hired to do. Just because of that, I should be treated as an employee. No, once again, they're going to be looking at the entire behavior and the 3-factor test. And now one factor is going to be heavier than the other. Everything in ones, they're going to be looking at making a determination. I do warn a lot of my clients who want to go this route, and I agree that they should be treated as employees, is that even though that you may, the IRS may take your side and say, yeah, you should be treated as an employee, they should have given you a W-2, you probably are still going to have a tax responsibility because no federal taxes were withheld. And as an employee, you are still responsible. Every single paycheck, you get a portion of Medicare and Social Security employment taxes withheld. So half of that responsibility is from the employee and the other the employer. When you're self-employed, 100% is your responsibility. So you are going to may see still have a tax responsibility, which is okay, but it will alleviate at least that half of the self-employment tax. And moving forward, if you continue to be employed by that company, you are going to be treated as an employee. So once you say, yes, I am self-employed, I have my own business, or I understand that the nature of my job is that I am an independent contractor. Now we're looking at Schedule C. Schedule C is a schedule that you filed with your tax return. And I just put a couple of the things that I've seen in the past, probably past year, the IRS questioning and auditing or doing an examination or asking you for further explanation of some of the items that you put on that Schedule C. The first thing that I've seen as I was discussing with actually my paralegal, who is you're going to be hearing from her a little bit later in this discussion, is that I had never seen hobby versus business being discussed by the IRS in all my practice. In the classroom when I was being trained to be an attorney and a tax attorney, we did study, but I had never seen it. And in the last year, I've seen 3 different cases. What does that mean? The IRS can question whether you have a legitimate business and whether the expenses that you're claiming are business expenses, or do you really just have a hobby? A good example, let's say that you are a coin collector. You collect coins, and every once in a while you buy and you sell. And you've done this for a few years, and you're out in the market, you Craigslist or Facebook Marketplace, whatever it is that you use. And it's become, just like I said, it's been a hobby, something that you do on the side. Now you're realizing that there's some, you want to spend more time. You see that there's a good financial option for you and for your family, and you want to become more of a business. So now you create, let's say, an entity. You go to somebiz.org in Florida Department of Business. You create a company. Maybe you even open a separate bank account, or you start just spending more time doing the coin collecting, and now you become almost like a broker of coins. Before, like I said, the IRS really wouldn't question this. I've seen that the IRS is questioning more, and the most important thing that they want to see is what is your focus on making a profit? We know that most businesses at the beginning are going to be losing some money because it's a new business. You putting a lot of money into the business. So the first couple of years, the first few years, the IRS expects you to have losses, but after those initial years, now the IRS is expecting you to start making some money. So it's important for you to keep good records of communication and how you have shifted from this being something that you do on the side on the weekends for fun to actually maybe making this a full-time job, or even a part-time job, or a big part of the economy of your household. So keeping records. Now we're going to talk about income and expenses. The IRS, like I said, I see a lot of tax returns that are prepared incorrectly, and I have my clients tell me, but I never told the tax preparer who all of a sudden said that I had a business, and it was either to inflate the income or to claim a lot of expenses and a big business loss to kind of eat some of your wages. So what the IRS is doing now is that they'll ask you, say, look, you reported on that Schedule C that you made $20,000. We want you to show us that you actually made that $20,000. A couple of things that we have done is, one of them is going into your bank account. If you're able to go into your bank account, and if you have a separate account for business, that's perfect, because we know that almost every deposit that's going to be there is going to be business related. So the IRS doesn't have a lot to question. However, most individuals don't have a separate bank account for their business. So it's not going into each deposit and seeing what is business, what is not business income. Another one is going through the Bureau of Labor statistics, and let's say that I am a landscaper, and seeing what the average landscaper in my area makes. That the IRS actually, in the IRM, which is the Internal Revenue Manual, when you're examining the officer who's examining your tax return, the manual is telling them that if the person cannot really show their income, that they can go to this bureau, and that's why I put the BLS, the Bureau of Labor Statistics, to see kind of how much money is being made by someone in that industry. Okay. But once again, it's so important. And one of the biggest issues I have with self-individuals, that most of the business are cash. So there's no real documentation. There's no 1099 that's going to be issued at the end of the year. There's no K-1 that's going to be issued. Keeping good records, the IRS takes something that even if you write down on a notepad, December 2nd, 2020, made $50, $100. The IRS will take that because, first of all, it was done at the same time that you earned the money. And they will take that as evidence. They have the burden of proof to show that you did not make that money. And it's pretty hard if you have a solid notebook where you've been writing each time that you make money. You're keeping good track and good record. In other words, so the key point is keeping a good record of that income. Same thing with expenses. Even though the burden is yours to show that you had those expenses, and the IRS tends to be a little flexible when they're doing an examination of expenses, and you can use what is called a Cohen rule. It comes from an old case that says that, look, if you can show exactly how much money you made on an expense, but you can show that you had the expense, then the IRS is going to give you some flexibility to prove how much you expend, or what was the deduction. Good example. Let's say I am a contractor. I do tiles, home tiles, and I don't have a separate bank account. I go to Home Depot and I use my personal bank account check card to purchase. So I may not have the receipt that says that I bought thin set or grout or the tile at Home Depot, but they can see Home Depot, $500 I spent. They don't know, they know what kind of work that I do. They don't know exactly what was purchased, but they'll give me the benefit of the doubt and give me the $500 of deduction. Of course, there's a lot of back and forth. So if you're able to keep those receipts, if you are able to keep a separate bank account for your expenses and for your business, like I said, all those deductions, all those purchases made with that card can be deemed to be part of the business. A big mistake that I see is in vehicle expenses and the mileage. The IRS, once again, wants you to have a mileage log, meaning that you are going to be keeping track of the miles that you drive for work, and keep in mind what is actual mileage that can be deducted and what is just commuting miles. For example, like I said, let's say I work as a general contractor doing tiles, and I have three different projects going on at the same time. From my house to that first project I drive that morning, that's a commuting mileage, which is not deductible. But I say throughout the day, I go to the second job, or I go to Home Depot to buy more product, or I go to the third job, or I go to someone's home to give them an estimate. Now that's becoming business miles, and I need to keep track. The last place that I go, and then when I'm returning home, those miles, once again, are commuting miles, and that cannot be deducted. The mileage, sometimes, keeping a good log is the easiest way. However, things that I've done with my clients who don't keep a log is keeping track of every time you have a repair done on your vehicle. And not because of the expense, but because most of the time, though, when you take it to the mechanic, they'll write down how many miles the car came in with. So if you can do that throughout the year, you can pretty much put together your mileage for the year. And if you decide to take the mileage as an expense, you cannot take the actual expenses, meaning you cannot take how much gas you paid, the repairs, the tire changes. You cannot do the depreciation of your car. So that's to keep something to keep in mind. Either you take the actual expenses or the mileage. And it just depends on the kind of work that you do, whether you're going to be taking the mileage or the actual you have to do, or your tax preparer is going to do the analysis for both and tell you which one's better. Home office, this is something else that has become an issue with the IRS in the last year or so. One thing that I recommend all my self-employed clients is take pictures of your home office. If you're going to be claiming that as a deduction, take pictures. The best scenarios, if you have an extra room in your house where you have a home office, that's perfect. If you don't, you can still claim it if that portion of the home is used for the sole purpose of conducting business. Okay, so just take some pictures, keep them on your record. Now with phones and with digital cameras, we can keep them forever, and you don't have to go to CVS or Walgreens to get them developed, but take some pictures. I think is the best scenario. And again, home office also is becoming a big issue, meaning that a lot of I've seen two cases just this year in tax court of the IRS questioning what if a home office is the primary place of business, because if it's not, that means all that mileage that you're claiming to go to different places for work is not going to be deductible. So again, keeping good record, making sure that you have pictures is going to help you. Meals is another thing that I see a lot of people driving, and some of those app drivers, unfortunately, they had bad advice from tax preparers saying that, look, if you are driving for Uber or for Lyft or another app-based application, and you stop, let's say you dropped off someone and you're on your way to pick up someone, or you're taking a little break and you go through the drive-through, McDonald's drive-through, whatever it is, that meal is deductible because you're eating on the job, quote unquote. Those meals are not deductible. So just make sure that you understand that. Anything that you buy, once again, for those who work in the app driver kind of industry, sometimes you buy water for your passengers. All that is not meals. Those actually are, you can claim them as supplies, and you get 100% of deduction rather than the meals that you'll get 50%. Okay. And now let's talk about and shift a little bit and talk about dependents and credits. And this is, like I said, the second reason why you get most of my clients or the taxpayers who file tax returns get audited, is because they're claiming some of these family credits and some of these credits, or they're claiming dependents. Okay. So a dependent is very easy. Is someone who lived with you for over 50% of the time in the year. And that you provided more than half of their support as well. Okay, and the credits are going to be based on that dependent. Just depends on your family status, your work status, and other factors that we're going to discuss. The earned income credit, and let's hope that this works, and it does. Let me just. The earned income credit is that big credit that we always hear people say, or you see advertisements during tax season. If you're gonna get $4,500 per dependent or something like that. Or you hear people saying, oh, I received a tax refund of $10,000. Most of the time, not all the time, but I would say 90% of the time is because of this earned income credit. This earned income credit is a credit that is an incentive to work. So if you earned income, in other words, if you went and worked, so this year, unfortunately, a lot of people who lost their jobs and didn't work, and they were the sole source of income for the household, maybe it was unemployment compensation. They're not going to be eligible for this earned income credit. So there's a couple of things that you have to understand is that you must have a social security number. So, or ITIN taxpayers, ITIN holders are not eligible for this. Unfortunately, you have to file either a single as head of household or married filing jointly. You file as married filing separately, unfortunately, you're not going to be eligible for the earned income credit. And like I said, you do need to be a US citizen or a resident alien to be able to claim this, okay? And you need to have earned income, you have to have work. This credit is also eligible for those who don't have children. If you're single and you work and you made less than the threshold, then you are going to be eligible for this. If you have children, of course, the children themselves also have to have social security benefit, social security numbers, or they have to be US citizens or residents. And they have to pass this test. One of them is that they had to live in the United States, so the substantial presence test, and they have to live with you for more than half of the time. And we'll go in a little bit into detail very quickly about what happens when there's divorce or separation and one child lives with one parent, but the other parent is claiming that child as a dependent. There's an age test, so they has to be younger than 19 or 24 if that person is actually enrolled full-time as a college student. And there has to be a relationship. And this is the biggest part of why people who claim earned income credit don't get denied, or they incorrectly claim this as, let's say they, a cousin, you claim a cousin as your dependent. Unfortunately, the relationship test doesn't meet the relationship test, and a cousin is not someone that is going to make you eligible for the earned income credit, or they're not eligible for the earned income credit. You know, if you're not married, your boyfriend, girlfriend's children, they might live with you, but if you're not married, unfortunately, also does not going to make you eligible for the earned income credit. So if you're eligible, if you say yes to all those things, yes, I meet the substantial presence, the age, the support, all that, then I'm going to be able to claim that earned income credit, okay? So and now we talk about the child and dependent credit. In the tax reform in 2018, we have now, they split some of the child and dependent credits, or the credits, the family credits, into two. The child credit continues to be the same. They increased the amount to $2,000, and 14 of those are refundable. In other words, you actually can get up to $1,400 for each child. 600s are non-refundable, which only means that if you have a tax responsibility, if you owe taxes, you can use $600 of that refund to decrease your tax responsibility by $600. The test is pretty much the same. The age test is a little bit, it has to be someone who is under the age of 17. So not like the earned income credit as 19. There's still a relationship test. The relationship test is broader. In other words, a cousin now can give you the eligibility for child tax credit, not for earned income credit, but for the child tax credit too. It does. There's still the support test. You need to financially support that person. And if the person does not meet that criteria, they have to be citizens and they have to be resident test. And there's, and your AGI or your income has to be a certain level to be eligible. If you go through this test and you say, look, the person who I'm claiming as a dependent, let's say is a parent. does not fit this criteria, or is a child that is not a U.S. citizen or U.S. resident and has an I-10, well, now that's when we're talking about the dependent credit. The dependent credit gives you $500 of non-refundable, okay? So that's kind of what I explained before, those $500, let's say you owe $1,000 in taxes, you can use $500 of that non-refundable credit to kind of eat up, and now your responsibility remains only $500 rather than $1,000, okay? So let's talk about what happens with a divorce and separation, something that also impacts our community a lot. And is that in a lot of the divorce agreements, I've seen that, a lot of family attorneys, family judges don't understand how this part works. So yes, you may be able to claim a child every other year, and that's fine. But what happens is that parent, there's always a custodial parent and non-custodial parent. For IRS purposes and for other purposes, the test is different. For IRS purpose or for tax purposes, then the custodial parent is that parent where the child spends the most nights with. So if you have what we normally see in a divorce agreement, that one parent has the child every other weekend and maybe a couple of days during the night or during the week, or one day during the that parent is going to be the non-custodial parent, because once you look at the calendar, you realize that that child is more nights with the other parent. By being the non-custodial parent, you still, on your divorce agreement, says that you can claim that child on, let's say, the even years, let's say. What that gives you is the power or the right to claim your child as a dependent and claim the child tax credit, okay? If the child is now in going to university, so they may be able to get the education credit. However, the earned income credit, because like I said, and I showed you, there is that residential, which it doesn't have on the other one. The child must reside half of the time with the person claiming the earned income credit. And like I said, this is unfortunately a portion that is being audited more and more by the IRS. And that non-custodial parent who claimed that child on that even year and claimed their earned income credit, I cannot prove that that child spent more nights with him or her. Now they're going to be having to pay that earned income credit that they received as a refund. Okay, so it's very important to understand this. And so what happens is that the non-custodial parent can still claim the child, get the child tax credit, get the other credits, and the non-custodial parent can claim that child for earned income tax credits, the earned income tax credit every single year. Okay, so that's what happens, and you have to split those kind of credits in that way. So it's something to understand and to know. If you're the non-custodial parent, educate yourself in that. If you do get audited, you understand that what credits you are eligible for, okay? And this is kind of just what I went through just now, talking about the non-custodial parent may not claim the child as a qualified child for an EIC or earned income credit purposes. The custodial parent will always have that right, okay? Let's talk about the education credit. There's two types of credits. It's the American Opportunity Tax Credit. It's only eligible for 4 years. So, you're only able to claim that 4 years, and only if you have not graduated from an undergrad. So if you're in graduate school, let's say you didn't know about it and you never claimed the American Opportunity Tax Credit, and now you are doing your master's degree or postgraduate work, unfortunately, the American Opportunity is not available to you anymore. It's only for undergrad. Also, they also tell you that you cannot claim it if you have been convicted of a drug felony. So if you have been convicted of any type of drug felony, you are not able to claim the American Opportunity Credit. The American Opportunity Credit has two factors, kind of like the earned income credit and the child tax credit. I'm sorry, like the child tax credit, not the earned income credit. That is part of it can be used as non-refundable, and part can be refundable. Once again, non-refundable meaning that if you all taxes, the American Opportunity Credit can come and eat some of that tax responsibility that you have. And if you have anything left over after that, you can actually get a check from the IRS with the remainder. The lifetime learning credit, you can claim it the rest of your life. You know, my husband makes fun of me because he says that I have more degrees than a Fahrenheit. I do. I've been in school for a lot part of my adult life. So it's something that the lifetime learning credit that I've been able to claim for many, many years is and that one is completely non-refundable, meaning that if I owe taxes, it can only come and help me, but I cannot get a check out of this lifetime learning credit. And it's a maximum of $2,000. Beware, now we're going into, you know, now that you kind of understand, hopefully you learned a little bit of, you know, if you're self-employed, if you know, what kind of documents you need to prepare your taxes, if you know, now with the CARES Act, now you need to find who is going to be preparing your taxes. And we have a little bit of time. I want to go over one of the cases that I see more and more and more in our clinic, especially here in Collier County. We do have two offices, one in Immokalee, one in Naples. And it's, let's say, I am a single mom and I have two kids, and I go and get my taxes done, and I hire someone because I don't know how to do my own taxes. Or I'm scared of doing my own taxes. That's that's why we have tax professionals. You know, you take all your documentation, you know, you sit there with the tax preparer, they tell you at the end, you know what, you're going to be receiving, Kathy, you're going to be receiving a refund of $5,000. I'm like, wow, $5,000. You know, like I said, single mom, it's going to help me a lot. And they asked me whether I want to go ahead and have that as a direct deposit to my bank account. I say yes. I give them my bank information. They take account number, routing number, all that good stuff. They give me a copy of the tax return. I go home. You know, they tell me to expect it within maybe 4 to 6 weeks. And the 6 weeks pass by, nothing happens. I check maybe online, where's my refund? Or maybe I don't know how to work the where's my refund tool on the IRS website. But I call the tax preparer. They tell me, oh, don't worry. They're just taking a little bit longer, but don't worry. Now 6 weeks have turned into 12 weeks, and then, you know, even longer. To finally, I decide to call the IRS because, you know, now the tax preparer maybe is still giving me the runaround or just not answering my calls anymore. So I call the IRS after being on hold for an hour and a half or 2 hours, finally get a live person. And I ask them, look, I give them my information, my social security, all that stuff. And I let them know that I haven't received my refund and I want to know why. And they tell me, no, your refund was deposited into the bank account that you provided on the tax return. And I'm like, well, maybe I missed it. I check my bank account and I say, no, I did not receive my refund. I don't know what's going on. And then they finally, so they put something on my account, which goes to actually the main US Department of Treasury. And then they can track where they send the payment. The same a few weeks later, I get something in the mail telling me your payment was sent to this bank account, and they give me the bank account information. And that's not my bank account. I don't know whose bank account that is. Come to find out later on that the tax preparer came after I left the office. It deleted my bank account information and put his or hers or their company's tax information, bank account information. And they had my refund deposited into their bank account instead. And now is a fight to get my refund. I can file a lawsuit in county court and try to get this person to pay me if they have the means to pay me, or I can fight the IRS to reissue the refund. This is what we've done, and the IRS, and in other cases that we have provided, this type of scenario, and we have to issue, we have to have police reports. We need to have evidence of that stuff. They've reissued the refunds, but it takes about 1.5 years later. So the $5,000 that I thought were going to come to be able to help me maybe move to a new place or buy clothes for my children or food or pay rent or pay my credit card bills, whatever I was going to be using this money for, now 1.5 years later is when I'm having access to this money. I'm not saying that all tax preparers do a bad job. Of course not. I work with many of them very closely in cases where, because like and later on, you're going to find out what we do as an LITC, and we don't do tax preparation. So I do work with a lot of tax preparers in the community, assisting them through their tax return preparation. But I do see that if someone's telling you, I can get you the biggest refund, there's no calculation, there's not a magic one that no one has, or they don't have something that I don't know that is going to get you a bigger refund. It's getting the person that's going to be preparing your tax return correctly, accurately, and that you actually are going to be receiving that refund. And so how to file the tax, you have to, how do I file my tax return? You can hire someone, you can do it yourself. The IRS has on their website all the forms that you need. They also have the on the IRS website an online for a free file, and you can go ahead and if you make less than, I think it's $63,000 a year, you can use this completely free. There's some type of income that if you earn, let's say if you have rental income or some type of income that you may have to pay something, but for a basic tax return with a W-2 and just basics, you can go ahead and use the free file, and you can buy actually a TurboTax or whatever it is yourself and do it at home. And the last thing is doing the voluntary income tax assistance or VITA. And for this portion and for the remainder of the discussion, I'm going to actually pass the baton to Maria Romero. She is the paralegal of the Low Income Taxpayer Clinic. She's my right hand, sometimes my left hand as well. And I'll let her explain what VITA is and kind of also what we do as an LITC. Yes, I think that she may be having some issues with her audio. Okay, so I'm not sure what's going on, but I'll go ahead and maybe then continue. So the VITA is a program that we have. It's a volunteer tax income tax assistance. It's in Collier County. It's actually run by the United Way of Collier County. We partner with them every single year. Our legal aid, our office is a site for VITA, and it's a completely free tax preparation service. I want to say it again. It is a free of charge, is $0 free tax preparation service. People who have been trained by the IRS to prepare tax returns. In other words, they're going to do it accurately. The United Way also has other sites around the county. They have about, I think, 5 or 6, and they also have in Immokalee, in Naples, both North and South Naples and Golden Gate. And the only thing that you need to do is, I know this year is going to be a little bit different from what we've done in the past. In the past, we open the sites and we make appointments and people come in with all the documentation. We prepare the tax returns right on site, and you get your copy, you go home, and then we go ahead and usually electronically file those tax returns. But because of the pandemic, even this year for 2019, we had to change the way that we do things. I know our site is going to be doing just depends, right now what we are looking into is doing a virtual clinic, meaning that all the documentation, you can either email it to us, fax it, drop it off in person, sign some documents. We'll prepare the tax return when it's ready for your review. We don't send any documents before it's reviewed by you. And we do quality control. In other words, one of us will always check each other's work to make sure that the tax return is done accurately. And like I said, you have the opportunity to review your tax return. When I'm the one who's preparing the tax return, and I have trained my staff to do the same thing, we go over the tax return so you understand what is on your tax return. So you understand that if you're being questioned by the IRS or by whomever, you understand what's on that tax return. So all you need to do is once next year, when, like I said, we're only like 2 months away from tax season, you can call 211. Again, it's just a 211 United Way number. say that you want to get your taxes prepared. They'll let you know what the qualifications are, what the sites are, and what each site is going to be doing. And then you can choose the one that's closest to you, or the one that is most convenient to you, and you can get your taxes done for free. I do recommend this. Once again, it's a free program. It's done for the community, by members of the community. Also, if you are interested in volunteering, you can also call today 211 and let them know that you're interested or becoming a volunteer. You have to go through the training and get certified to become a tax preparer. You don't want to become a tax preparer, but you just want to do like an intake specialist. You can do that as well. But it's something very important, and I continue to stress to take advantage of this. So what is it that I do in the low income taxpayer clinic? Again, I do not just do tax preparation. I get a lot of people calling me, unfortunately, who haven't filed taxes in 5-6 years, and they call me for that type of assistance. We don't provide tax preparation outside VITA. Okay, so VITA is one thing, but for what we do every day, we help taxpayers who are having IRS disputes, so tax disputes. People who receive letters from the IRS saying that they're being examined. So there's an audit on their tax return because there's, whether it's their dependents, their earned income credit, there's Schedule C business income is being questioned. Identity theft issues, whether the IRS wants you to call them to verify your identity to make sure you're the person who filed the tax return. We can assist with that. We assist with individuals who are not eligible for Social Security numbers, but they do want to, and they have a responsibility to file tax returns, and they can petition and request an ITIN. It's a number that is used for tax reporting purposes only. So we do that. We take cases to, we represent clients before the IRS, federal court for tax purposes, and tax court. We have moved a little bit since I moved into the becoming a director of this clinic, and really doing a lot more litigation. But also for individuals who maybe you owe money, maybe in previous years you got audited and now you owe money, or you have been self-employed for several years and you haven't been able to pay your tax responsibility, then and you have accumulated, we can help you with some of the collection options available within the IRS. So this is the list of items or disputes that we provide assistance with. And the last thing is that to qualify for services, you must be a resident of Collier County. If you are not a resident of Collier County, but you do have tax controversy issues, you can always give us a call and we can refer you to the clinic that's closest to your county, Lee County, Broward County, or Miami-Dade, wherever it is. You must be, your income must be below the 250% of the poverty line, and always call us and we'll let you know whether you qualified or not. There must be, like I said, a tax controversy, not just tax preparation. And your tax controversy must not exceed the $50,000 threshold for any year. So overall, in total, let's say there's 3 years in controversy, can be more than $50,000, but each year has to be less. And it's just because for tax court purposes, if you want to put your case through, let's say it's a case that we have to litigate, we usually are able to do it through a small case program that the tax court has, and the tax liability, or the maximum or the limit in tax liability to have an S case is of that $50,000. So if the tax court changes that, we also will increase that amount. This is our contact information. Like I said, we do have an office in Naples and in Immokalee. Give us a call. If you have any questions that I'm giving you, also that is my email. You can email me with any questions that you may have. And if you received any notices from the IRS, we'll be more than happy. If we cannot take the case for whatever reason, we do have a pro bono panel of tax professionals in the community that can take on the case. Let's say because you don't qualify because of your income level or whatever it may be, we can always refer it out, or we can just give you counsel and advice on how to handle your case within the IRS. I hope that this has been educational and informative discussion. And like I said, if you have any questions, please feel free to call us. Thank you so much for your attention.